Hello, everyone. This is Josh McCarthy with LifePoint Planning. Excited to bring you this video today. We're going to be talking about how you can take $100,000 in retirement income and pay $0 in taxes. It's all perfectly legal. It is just all about smart planning and understanding which accounts to take from because different accounts, and this is what you'll find in this video, different accounts are taxed differently than other accounts. So let's dig into our case study here. We're going to have Jim and Jane. They're both 67 years old, married, filing jointly. They're retired, and they're currently pulling out $60,000 a year in Social Security. So $3,000 a month coming to Jim and $2,000 a month going to Jane for a total of $60,000 per year. They also have $1 million sitting in their combined IRAs. And they also have $500,000 sitting in a brokerage account with a cost basis of $250,000. Also, something to note is we'll assume a 2% dividend yield coming out of that brokerage account, which will pay them $10,000 per year. And right before we get into the case study, I'll also mention we are excluding state taxes out of all this because every state is different. We do have clients all over. And so we're not going to pigeonhole into just one state. We're just going to exclude that for the sake of this video and only work on federal income taxes. So let's dig into it. All right, so let's go through how we can get that $100,000 of tax-free retirement income. We are using some planning software, and so it's going to showcase exactly how it's going to work. I've inputted the client's information. We're adding $60,000 of Social Security to it, and that's our baseline that we're going to start at. And we go over here, and we can run a tax report. Tax reports are really cool, and what it's going to show us is in the bottom left, the total amount of taxes we are going to be paying in this scenario that we're being given. So as you can see, we're taking $60,000 of Social Security income. We're paying $0 in taxes on it, or $0 of the 60 grand is getting taxed, I should say. Basically, we're going to see that number go up because of something called provisional income. Not going to get into the weeds of it, but as your income goes up, as we take withdrawals from other places, the amount of our Social Security benefit that is taxed will also go up. So we'll see that as we continue to take. But $60,000, still paying $0. We have that standard deduction of $33,200. So let's go back. Let's put in our dividends that we're receiving. As mentioned, we're receiving $10,000 in qualified dividends. And excuse me on that. All right. Do that. Close it. All right, perfect. Still showing $0 in total tax. As we can see on the far left, you will notice our total income is now up to $14,000. It's coming from $10,000 of qualified dividends and $4,000 of the taxable Social Security. So as mentioned, as our income goes up, so does the amount that our Social Security gets taxed. But we're still all good to go. Deductions, taking care of all of that right now. So let's say we want to take 10 grand out of our IRA as well. This would now put us, if you're doing the math, at $80,000 per year. All right, and as we can see, our total income sitting at $31,100 now, still under the deduction of $33,200, and our total tax still $0. As mentioned, you can see the taxable Social Security going up, but still we're okay because we're under that deduction. So how are we going to take $20,000 more and not pay any taxes on it? All right, so if we remember, our $500,000 sitting in a brokerage account, $250,000 is the cost basis. If we want to withdraw that last $20,000 to give us $100,000 per year, we are going to pay a long-term capital gain of $10,000 on that $20,000 sale of securities. Not going to get into the weeds on that calculation itself, but that would be the case. So we're going to come here. We're going to put our $10,000 of long-term capital gain. voila, and we have $0 in total taxes. And the biggest thing you'll notice though is the taxable income is at 16,400. So we're well above, our total income's well above the deduction. So how are we still paying $0 in taxes? And it's simply because different accounts are going to be taxed differently and different income sources are going to be taxed differently. Our Social Security is taxed at ordinary income. Our IRA distribution, which isn't a line item here, but the IRA distribution that we took of 10,000 is also taxed at ordinary income. But that 10,000 from the IRA and 19,000 of Social Security, that's still coming up to 29,600, which is below the standard deduction. As for the $10,000 coming out in qualified dividends and the $20,000 coming out of our brokerage account showing a 10K capital gain, those are taxed at different tax rates. And we can show it down here. All right, here's our marginal tax brackets for long-term capital gains and qualified dividends. Well, it's $0 all the way up to 96,700. So that extra 16,400 is just not getting taxed at all. Yeah, so that is how it is done. Jim and Jane getting $60,000 from Social Security, $10,000 for qualified income, $20,000 from their brokerage account, and $10,000 from their IRA distribution, getting them $100,000 total without paying a single dime in tax. Now, I'm not the first one in the world to make a video like this, but what I don't see is what people are not talking about, which is, does it even make sense to pull $100,000 and not pay a single dollar in tax? It might not, and it varies from situation to situation, but I'm going to show you another example here. It's basically the same example. Instead of pulling out of our brokerage account, we're going to pull that extra 20K out of our IRA. So here's the example here. Again, everything else is the same besides the fact that we did not take any long-term capital gains, and we took a $30,000 distribution from our IRA. That total tax down there is not bad at all. $2,500 when we're taking a total income of $100,000, your average rate is 3.7%. That is not a bad deal at all, especially when we worry about getting to RMD age or required minimum distributions, when you're being forced to take out money from your IRA. So this could make a lot of sense to simply pay some tax up front, so we try to avoid a bigger tax bomb in the future. But just wanted to show this as an example. It might not make sense. Maybe it does make sense to pull some from your brokerage account. Who knows your exact scenario? But just wanted to show the other side of this. So that's it. That's how you get $100,000 tax-free in retirement. With that being said, it might not always make sense. So feel free to reach out. Let me know if you have any questions. Happy to help in any way, but hope you enjoyed this and learned something.